Guys, for months, investors have been asking the question, when will interest rates come down? And I think we've been asking the wrong question. The latest economic data is beginning to change that whole conversation, okay? And let me show you why. Just a few months ago, inflation looked like it was what? Finally moving in the right direction. The Federal Reserve was making progress. Investors were out here expecting rate cuts. Remember the beginning of the year? And a lot of people assumed that the cost of borrowing money would start to come down. But that's not what's happening anymore, okay? The Fed's preferred measure of inflation that they use, called the PCE, has now moved higher for 3 straight months. And that's headline PCE inflation. It's gone from 2.9% up to 3.5 to 3.8, and now it's at 4.1%. Core PCE, which strips out and removes the food and energy from the equation, has also moved up higher, up to 3.4% right now. These are the numbers of an economy where inflation is becoming a big problem again. Sort of quietly, okay? And that's where this whole thing gets a little more interesting, because with inflation moving higher instead of lower, can we really expect interest rates to come down? That would probably be a no. And here's why not. The Fed funds rate is the rate that banks charge one another for overnight lending to each other. And when the Fed, who controls that Fed funds rate, lowers the rate, banks turn around and lend us money at lower interest rates. And that means money is cheaper to borrow, right? Now here's the deal. If money is cheaper to borrow, guess what happens? People and businesses start borrowing more money. And when people and businesses start borrowing more cheaper money, spending goes up. Spending more money makes demand for goods and services also go up. And when demand for goods and services go up, prices go up. And we see higher inflation. So essentially what I'm saying is this: lowering the Fed funds rate, the interest rate, tends to be inflationary, because it encourages more borrowing and more spending by consumers and businesses. So if inflation is already going up higher, the Fed is now less likely to lower the Fed funds rate. And if inflation keeps going up faster and faster, raising the interest rates will probably be the more likely next move by the Fed. Why? Well, because raising the Fed funds rate, or raising the interest rates, makes money more expensive to borrow. And it sort of disincentivizes, or sort of discourages people and businesses from borrowing and spending more money. That's one of the ways that the Fed uses to slow down inflation. Raise the interest rate, make money more expensive to borrow, and people stop spending so much, right? And that typically stops inflation from going up so fast. And that's why I believe that we've been sort of underestimating the possibility of higher interest rates later in this year. Remember now, just 4 or 5 months ago, almost everybody was talking about rate cuts. Today, the conversation is rates may have to go higher to slow down inflation. And most people, I don't believe, are ready for this. Now, here's the deal. Inflation doesn't just rise on its own. So what's causing inflation to go back up so fast, so quickly? There's really 4 things that I'm watching closely. And the first one is simply this. Let's start with what we already know. And that is this: 3 straight months of rising inflation, it suggests that inflation is clearly headed in the wrong direction. And it's likely not coming back down anytime soon like we expected. The second thing that I'm watching is energy. One of the biggest drivers of inflation is what happens with energy. When oil prices go up, it doesn't just affect what you pay at the gas pump. I know that's the main thing that we see on the streets, right? Gas has gone up to $4 or $5 a gallon. But when oil prices increase, the cost of almost everything goes up. Transporting goods around the world or the country, manufacturing or making products, those prices go up. Airline travel, shipping, and ultimately the deal is when oil prices go up, thousands and thousands of products and services throughout the entire economy are all affected by these rising costs of energy or oil. Now look, we know that we have continued uncertainty over in the Middle East. I'm not going to go into that whole fiasco on this video, but just remember this: the energy markets remain on edge. Let me say it like this. Even if oil prices don't stay elevated and they for some reason come back down lower, the risk of supply disruptions like we've seen since the conflict over the Middle East is really enough to keep inflation pressures higher than most of us expected just a few months ago. Now, the next thing that I'm keeping an eye on is this: tariffs. Tariffs may protect certain industries, but they also increase the cost of imported goods. That's a fact, okay? And somebody eventually has to pay for that higher cost. It's obviously the importer of whatever you're bringing in to manufacture or make whatever you make at your business. But oftentimes, guys, that cost gets passed on to who? The consumer. The business that needs to buy it, or the consumer that needs to purchase it. That's us. And that means the higher prices because of tariffs and tariff pressures make it even more difficult for inflation to actually move back down towards what? That Fed's 2% target that they've been talking about for the last several years, but they have not hit. Now, here's the part that I think most people are missing. Under the new Fed chair, Kevin Warsh, the Fed has become much more cautious about signaling future rate cuts. They're trying to not give away their hand and tip off exactly what they plan to do. And so instead of telling markets, hey, here's where we're going with the interest rates, what they're trying to do nowadays is stay away from tipping their hand, and they're emphasizing incoming economic data as opposed to just the historical data, okay? And that's important because the incoming data has not been improving. It's been moving in the wrong direction. Higher inflation. Now, the Fed has also raised its inflation outlook for this year as well. Now, that doesn't guarantee that higher rates are going to happen, right? I'm not saying that, but it tells us something really important. Inflation remains a much bigger concern than many investors and regular consumers realize. And I know the stock market has withstood all of this so far, but it remains to be seen what happens in the stock market. Now, does all of this mean that the Fed is definitely going to raise their interest rates later this year? No, right? And honestly, guys, nobody knows at this point exactly what's going to happen. But I do think the market may be underestimating that possibility. Just a few months ago, almost all of us had this assumption, and we were doing videos about it all the time, that lower rates were coming. Today, inflation's moving in the wrong direction. The Fed is becoming more and more cautious. And again, the conversation around this whole thing is changing. And that's why I'm doing a few things. Let me explain what I'm doing. One, I'm staying financially flexible. In other words, I'm keeping some cash available. Now, I'm not saying I'm stockpiling cash like Warren Buffett, but I'm keeping some cash available in terms of my stock portfolio. I'm also avoiding unnecessary debt, which I do anyway, right? Primarily the bad debt. Third thing I'm doing is I'm continuing to invest consistently, and that means dollar cost averaging. My plan hasn't changed. I'm dollar cost averaging into the market, into my ETFs, my index funds, and even my single stocks. And I'm also, watch this, the fourth thing I'm doing is I'm preparing for multiple outcomes in terms of inflation. Not just what I hope happens with inflation, right? Because if you want to be successful in this investing game in the stock market, you don't want to just sit around and wait until the headlines change. You want to prepare while everybody else is still assuming that yesterday's story is going to be tomorrow's reality. Because we know that the story changes constantly, right? So we have a plan and we stick to our investing plan. We don't base what we do in terms of our investing on these numbers that are just changing every other month. Now, just like everybody else, I hope the fighting over near the Strait of Hormuz ends, the strait opens up and, oil starts to flow and the price of oil comes down and inflation comes down. I hope that interest rates eventually come down too, right? All of that would be good for consumers, for businesses, for investors, and really for the overall economy. But listen, hope is not a financial strategy. For real, right? As investors, we have to pay attention to what the data is telling us, not what we want the data to say. Right now, the data tells me inflation is moving in the wrong direction. The Federal Reserve is becoming more cautious, and the possibility of higher interest rates later this year is greater than many people realize. Look, maybe inflation cools down over the next few months and none of this happens. That's certainly very possible. But if it doesn't and inflation keeps going up, then we know that this is why the Fed could likely raise the Fed funds rate as opposed to lower the rate. And let's be clear, the Fed has not raised the Fed funds rate in 3 years. So this would be a real change. And that's why I believe that most people really aren't ready for this flip in how the Fed is handling the Fed funds rate. Look, most people are still preparing for lower interest rates when they really should also be preparing for the possibility that money will become more and more expensive to borrow. The deal is this: you don't have to predict the future to try to build some wealth. You just have to be prepared for more than one possible future outcome. If you got value from this video, do me a favor and smash the like button below. Drop a comment and let me know, do you think the Fed will raise interest rates later this year? Yes or no? Just let me know in the comments. And share this video with someone in your network of good people. Until the next video, peace.